American University in Bulgaria.
I believe we can start. I appreciate you come to this interesting lecture. We have really a rock star here. Vesko is coming for this lecture for the last, I don't know, maybe 7 years.
Even more.
And we have something in common to share. This is the experience with me. You can see that he graduated in 1995. University of Maine. I was there recently. Anyway, I'm very proud to have Vesko again. With this very promising, interesting, and challenging lecture. I'm also very proud to have all of you here. Thank you guys to share your time with us. This lecture will be recorded by AUBGTalks. Okay, so they will be placed on their website, and you can watch the lecture later. And also, I'm going to use this for my future classes because this is one of the most interesting and exciting presentations. So I don't want to waste to spend any time to say good or bad words for this guy. He's a very good friend of mine. Enjoy the lecture, and if you have any questions, whatever, this lecture is open for any questions and discussions. So thank you to be here today.
Well, thank you very much. I'm really impressed by the crowd. I came all the way from Sofia today. Maybe I'm not sure how good this will be of a textbook material. I'm going to talk a bit about options, but I didn't really want to do it all about options and all about these different trading strategies and most of these combinations. Most of that stuff you can certainly find in your textbooks and any basic textbooks on options. What I would probably share with you is my general investment experience, things I've done, some things that I've learned, and some strategies that I have used. I also want to talk a bit about a few other things. I want to talk about what's going on in the world today, which some of you may find important. I'm going to talk a little bit about economics, and then we're going to talk options. At the end, I'm going to talk a little bit about, investment psychology and technical analysis about stocks. Some basics, but then yeah, if you pay attention, you might learn something, I'm telling you. Some basics, but, most basic stuff and some more sophisticated stuff that I've came up as a solution as I've been doing trading and been dealing with that stuff for a while. I am from the very first AUBG class. I started here in 1991. I never graduated AUBG. I stayed here for 3 years and I transferred to the University of Maine. I graduated there. So I stayed here for the last, but I kind of do feel I am from the very first class, although I never formally graduated AUBG. At the moment, I have a company in Bulgaria which has many different things. It attracts investments to Bulgaria. My website is investbulgaria.com. And I also branch out in many other different things throughout, not only Bulgaria, but in the world. So we talk about option trading strategies, what options are about, and contemporary events in the world. So options, that very cute little pictures I have for you. Normally when you read magazines and you browse the financial websites like Bloomberg and Yahoo and all these things, when the marketplace has a very good day, you see pictures like this. Seems like somebody who knows exactly what he's doing hit the jackpot and now he's enjoying himself. If the day is particularly ugly for the markets, which means the markets have sold out, you could see one of these guys, traders, normally those green jackets with those little numbers means the guy is a trader on the floor of an exchange somewhere. So he looks panicked. The reality is a bit far from that. The most realistic thing to explain the stock market would be this guy. Most of these guys are completely clueless. They follow the crowd. They just don't know really what they're doing. But still they work for investment banks and companies. And they have great egos about it. In reality, they pray their positions will eventually go their way and they'll get their bonuses. So let's look at the marketplace today. I need Yahoo Finance here. Close this. Kill this, and I have that. So the markets just opened. They opened at 4:30. So the markets have been open for about 3 hours now, or maybe 2. I'm not sure how the time difference is at the moment. Then we go to Yahoo Finance. It's one of the most popular sites with very good graphics, very up-to-date information. An alternative to that would be the Microsoft site, moneycentral.com or Bloomberg. So pretty much, let's see what's going on in the world today. The markets have been open. They close in 2 hours. Pretty much nothing really. The Dow is down 4 points. 11 points. Standard & Poor's is down 4 points or something. Not really much happening on the stock market today. There's some very smart guys, if you read those articles, that tell you exactly what's going on in the world and what will happen, and you surely should pay attention to them. For example, there is somebody says there is $1 trillion student loan. $1 trillion is a massive amount of money. Some people argue there is a massive student loan bubble in the US, which is fueled by government support of irrational low-interest student loans. This is about to play out. We'll see if what this is going to happen. Samsung is puzzled as a smartphone something. Here is something that's really interesting, because most of this stuff is garbage and you shouldn't even look at it. But here is something interesting. Russia to set up its own payment system. Now that's a massive news for the market, especially if it really happens. For those of you who understand money, banking, and the global financial system, you would know that most payments from any bank anywhere, from Mongolia to Vietnam to the United States, they need to settle through the United States. After the Bretton Woods Agreement, the monetary policy, the dollar is as good as gold. And there is this system which is called SWIFT, and any transaction throughout the world has to go through it. In reality, it's a ridiculous idea. It means if I owe you money, I have to kind of go not this way, but this way, and then that way. So while the Americans are threatening people with sanctions, doing all these garbage, the Russians are actually doing something smart. They say, well, I would probably like to develop my own SWIFT system, which is just a software program that recognizes credit cards and numbers and takes payments from point A to B. But I don't want to go from here to there. I'd like to go directly. This stuff like that could have enormous consequences for the world economy. So that's why I recognize this piece as an important one. And we'll talk later about why this would be important. Jim Cramer is one of the smartest guys on the CNBC. Pretty much anything he says on television is the exact opposite of the truth. I could show you not only the wrong thing, but the exact opposite of the right thing. You could browse him around and see Jim Cramer, his most famous flaws. His most famous flaw would be when he said that Lehman Brothers, when it was $80 per share, was absolutely fine and everybody should be buying Lehman Brothers. And the very next morning, Lehman Brothers woke up at $3 per share and went bankrupt about 15 hours later. So he obviously has a reputation of a very smart, prudent investor, and that's why they keep him at CNBC or something. So anyway, that's what's going on. Interesting things to look here would be the Standard & Poor's, which, are you seeing my mouse? The Dow Jones Industrial Average is at least it's famous for representing the major 30, the 30 biggest industrial companies in the United States. It's fairly accurate as a general levels of the market, but it's limited because it's only 30 companies. From the very original, there's probably at least one, I think maybe it's Alcoa, that's still a member of the Dow Jones Industrial Average. So the Standard & Poor's 500 is the 500 biggest American traded companies, and it's a more accurate, of what's going on in the American market. And then the NASDAQ is the other exchange. It's an electronic exchange, again in New York City. Most tech companies do trade there, So what we want to know is several things, and I have slides for them because I looked them up before I came. We want to see the Standard & Poor's, the Dow Jones, the NASDAQ, and that is very important one, the 10-year bond. Yeah, I'm sure you've studied bonds, you know how to compute them and all that stuff. But bonds are very, very important. And especially if you're a smart, prudent investor, the 10-year yield is something you watch every single day. And I'll show you why. So back to my presentation. If I can maybe do this. This is out of this morning, so we are plus minus some points. That's the Dow Jones Industrial Average for the last 30-some years, maybe just about 30 years. You could see America, I mean, if that could be an indicator of the American economy, it's been growing steadily and slowly. Lately, as of 1997 or something, it started going exponential. Maybe we witnessed tremendous technological advances and our life changed. So it went here, this crash, what we know is the dot-com bubble. I was lovely working in America here in Boston. I was driving a Lexus and I was only 22. The salaries were great. These were the go-go days, guys. Well, this thing crashed and everybody pretty much went out of the market. Well, a remarkable recovery happened. So now we're back to here, about 2007, 2008. The market crashed again because of maybe there was another bubble. It was a real estate bubble, and together with anything else, the market crashed dramatically in no time. About in the September, I was back in the States again, 2008. Now we see another miraculous thing happening. We've not only recovered all our losses, but we are in trade territories we've never seen before. So the Dow Jones is way out there. So obviously things are going very well. The United States is doing remarkably well. We have to figure out why exactly and what could happen. On the other corner of the planet, we have the Japanese success story, which soon to happen into a disaster story. But back in the days, after the war, Japan was a real, beaten down after the war, losing country with agriculture and low-tech garbage, just like China was, maybe some 25 years ago. The Japanese had a tremendous success story. They started producing all kinds of high-quality stuff, selling it throughout the world. But back in sometime, 1990, the Japanese market crashed. I mean, it crashed big to levels we haven't seen in about, maybe how many? We're talking 25 years. And Japan cannot recover to come close to, its highs. When the Great Depression happened in America, the stock market crashed in, 1929, and it took exactly pretty much that much time after World War II. Eventually, it picked up to the previous levels. Not only that, but we see this continually is getting worse and worse and worse. Lately, however, Japanese market is showing a remarkable recovery. From about 7,000 points, it pretty much has doubled, which is very good. Obviously, something very good is happening in Japan. Now, this is the interest rate, what I mentioned in the morning. That's the 10-year yield and the 10-year bond. That means if you give, the most reliable country in the world to give money to is, of course, the United States. And if you'd like to work hard, save $1,000, you have enough money to purchase a bond, a government bond, 10-year bond. This is the history of interest rates since 1962. At this time in our life, the 10-year yield is ridiculously low. It used to be 1.67, which is the lowest point, and now it's up to what? 2.7. That means if you work very hard and clean floors here, save $1,000, give it to the American government, every year they'll pay you $27, and in 10 years, they'll give you back your $1,000. Everybody in the world considers the US government obligations the safest in the world, and Jim Cramer on television calls this a safe haven. However, I'm not sure if he would really like to invest his money like that, because the levels of interest rates are extremely low. I mean, not seen in the entire history of the industrialized America. So that should ring a bell. Just to remind some of you, when there are all these smart finance guys in the States they ask him what caused the crash of the 2008 real estate bubble. They say, well, the primary reason for that was we kept interest rates too low for too long. So they had a very serious thinking, and ever since 2008 they've kept them flat at 0%, from 0 to 0 point, very little. That's the Fed rate of newly created money. So the solution was to do it even better, even more. So just to realize how important this is, I made these two slides for you, because it's a very fundamental thing to understand in economics. I break it down into very silly things. A saver is somebody who produces more than he consumes and saves the difference. Once he's doing this, he has some money left as savings. That's his wealth. Having this, he's seeking promising investment projects. Would it be his latest car wash business or your whatever else you come up with? So you come here, you have a great idea, but you need capital. And you want to borrow money. He is the borrower. He has a project and idea in mind and seeks capital. So we sit down and we say, okay, let's see what the risks are for this. And could you fail, or how successful could this thing be? Historically, normally people have said, okay, I'll lend you money, but rates have been around 7%. That's been the case. Unfortunately, this is not the case at the moment. Right from Yahoo Finance this morning, we could see the rates. This is just from finance. If you have saved $1,000 in American bank at the moment, and you just put it into a savings account, you're only going to get half of 1%. That means $5.40 if you lend the bank $1,000 of your money. If you're, of course, a bit smarter than this, you would say, I'd like to buy a CD from the bank. So a CD would pay, $8.50. Of course, the CD is a ridiculous idea by itself. It's a bank product that they sell. And the moment you buy a bank CD, they turn around and they buy a government bond at 2% or something, 3%. So you don't want to buy a CD. You can certainly buy this bond yourself. But of course, people believe that CD is a very smart thing. It's guaranteed by the bank. Whatever you do, even if you buy a government T-bill, you're only going to make $29 out of 1,000 every year. Now, as good as his business idea sounds, 2.9% is a disappointingly low return for any investment. So that turns out to be a very major problem in the economy. I need to have a couple of sliders to explain to you. Right. When I spoke about doing not the right thing, but the exactly opposite of the right thing, in an economy that needs to grow, it needs two things. Give me a couple of slides later, I'll explain. You need savings and investments. Borrowing and spending is exactly the opposite of wealth. So what these interest rates do is they discourage savers from, actually saving money and investing into prudent enterprises. Instead, because they don't see any alternative to this garbage here, they try to go their money into much riskier investments like the stock market, which is on highest level ever, or real estate bubble markets, which are being created because of them interest rates. It's a very interesting thing. When you look in the mirror, so the reality is very difficult when you talk about markets, valuations, and how much would Amazon or Microsoft cost today. Because of the interest rates are so very low, artificially low, it's very hard to say. You look in the mirror, you don't exactly see the reality. You see a distorted something which the free market will actually correct. If you realize this, you're 2 steps ahead of pretty much everybody else. And oftentimes such policies fuel bubbles. When you have too much, they call it liquidity. That's another way of just a scientific word of too much money dumped on the market of very little rates. You have, create bubbles. Prices go up, especially if they're guaranteed by the government. And these bubbles pretty much always end up with a violent burst on the downside. In the history of the Western civilization, at least as we know the American markets, every 6 to 8, 7, 9 years, there is a massive correction in the stock market. The last one was 2008. You guys are very good in mathematics. We would probably know that something around the corner is coming. And maybe you quote me next year when I come, hopefully teach again. We live in a massive world of debt at the moment. This I found a very great iconographic this morning. And this is stacked, the debt of the world stacked in $100 bills. This would be a person right here, and this is the whole truck carrying pallets, double stacked, of $100 bills. And you could see, I mean, where the debtors of the world are. I mean, it starts from the United States, has insane amounts of debt. Then comes Japan, Italy, France, you know where the debtor nations are. The creditor nations, they're not exactly here, but we're talking, you know, China, Taiwan, Korea, and all these guys that produce more than they consume, save the difference, and lend it to other people. Those people who make jokes about Russia and can constantly ridicule them about how stupid and retarded they are, you could probably notice that virtually Russia has very little debt out there. It owes about 20-some billion dollars, which Putin could easily write a check tomorrow and get it over with. Not exactly the case of the so-called Western world that we are proud members of. It's a very important thing to understand. And I call these guys, what we do, we are playboys with credit cards that have very little limit. We don't really understand what wealth is, where it comes from, how it's being created. We just have it, and we spend it. We live the high life of them guys. I mean, I was looking for pictures, so this probably would be the one. So especially that guy with the Mercedes. All he does is go around, showcases his yellow suit, and spends the money that maybe his father made, but at least he didn't make. So history shows that when one cannot live above their means, beyond their means, forever, and at some point, we need to face the music. Economics is really, listen very carefully to this one. It's very important. Economics is a very simple science. Contrary to what Jim Cramer and most professors at AUBG, no offense to anybody, will tell you. But the science of economics comes up all together into this very simple line. Do memorize it right now and you can pay me later if you understand what I'm saying. Wealth equals savings plus investments minus spending minus borrowing. Now you know economics. Congratulations. This is it. Really. We have another problem. I mean, what this guy should really be doing would be this. This is a guy who went out there, who sacrificed himself, came up with a new product, worked hard all day, and went out there and sold it to other people. He invested his money and effort, he produced something and dumped it on the market and made money. So he's increasing his savings and his investments, while this guy is just wasting all this hard work that actually gets transformed into the yellow suit and in the car itself. So we have this one dilemma in the Western world right now. Our very smart politicians and leaders, they believe that the solution to debt and spending is even more debt and more spending, while we clearly know that it's exactly the opposite, because now you understand economics, remember? The more debt you have and the more spendings you have, you need to face the music at some point. Our politicians seem to believe exactly the opposite. Actually, very smart guys who know nothing about economics are getting Nobel Peace Prizes, Nobel Economics Prizes. Not a single Chinese or what's the greatest success story? That's Singapore. Not a greatest single Singaporean guy has a Nobel Peace Prize, Economics Prize, or any recognition. Even though 50 years ago this thing was a swamp, and I have the highest standard of living everywhere. So, what we're seeing in the world today, if we pay attention, these are global shifts we have to know. The countries that save and invest are growing. This is Vietnam, that could be anywhere, mostly China, of course. And the countries that spend and borrow are in very serious relative decline. I mean, I can certainly name them right away. This is the US, Japan, England. These are not the biggest I mean, this is the biggest debtor nations in the history of the world. Not in the world, but ever. So we see wealth moving from east to west, from west to east. And for anybody who has pretty much any perspective, it's very, I'm happy to say it, but the 21st century belongs to Asia, and we should probably not study French. Chinese is the better option. We should probably brush up our Chinese. We used to laugh at our parents because they didn't know any English when we were kids. Now our kids, chances are they'll laugh at us because we don't know any Chinese. Something to think about, really. So what's going to happen in the next year, maybe this year, next year? We have a massive euro debt crisis, which is about to increase dramatically. You would read the news and they'll tell you that the Greek problem is solved. No, wait a few months and you hear it again this year, many times around. But then we have Italy and we have Spain, and the euro idea itself, if you look at it and research it in detail, it's an impossible idea to sustain. It's a chasing game of who's going to take more money and who's going to spread more inflation on the other ones. So euro is about to collapse at some point. All these smart politicians that tell you, oh, we really want to get into the euro, like Bulgarian guys, I mean, it's like great to just see a Titanic hitting an iceberg and say, could I please have a ticket to the Titanic? You know, I'd really like to get there. We have the other currencies engaged in so-called currency wars. It's cute sometimes what the mainstream media comes up with all these garbage names like currency wars, quantitative easing, tapering, and all this stuff, which only, I mean, means vague concept. But currency wars, as they put it today, is because the United States dollar is being produced in massive quantities. Other countries try to match this under the argument that, oh, if that our exports are becoming too expensive, if the Americans are inflating their currencies, we really have to inflate ours as well. So everybody is doing this. To my stunning surprise, the Swiss guys and the Swiss franc is actually got pegged to the euro at 1.6 level. So really there is very little safe haven out there to get out of it. Again, back to the mirror story. Distortions caused by the very low interest rates on the marketplace by central banks are making it very hard to measure the real value of stock, bonds, traditional investments, mutual funds, options, and so on. So do we have crazy valuations again? I was preparing this slide this morning, and this was last time, which was last year. I think it was last year. So I had this slide last year, and I was showing Amazon.com. Back then, Amazon was $258. And, you know, Amazon is pretty much a website in America. You can buy, sell stuff on it. You can, you know, buy books and all that stuff. I mean, just a website, really. Maybe they have massive warehouses here and there, but it's a website. So they were, back then, they were worth $120 billion, or just about, you know, the whole capitalization of this company was $117 billion. Not only that, but they were actually losing money. Price-earning ratio, it's probably one of the most important things that you want to learn when buying and selling stocks. It actually tells you how much money these guys make. After all the accounting gimmicks and all that stuff, you even want to imagine that this is even worse than this. So if this, I mean, they're losing money. They're losing 10 cents a share. And meanwhile, they are, you know, worth $117 billion. Over there, I was recommending to my students, this is an insane valuation, guys. This is against anything. As if he has a business and he only made, you know, $10 today in profit for this year, and I come to him and I offer him, you know, $2 million for this business. He's becoming ridiculous out of any street logic. So I made the fat recommendations to everybody. I think, guys, this is too expensive. Maybe we short this and we sell it. Well, boy, wasn't I wrong, though. Check it out. This is out of today. So the 258, this baby now sells at 354. Hey, he was up to, where is the 24-year range? It was up to $408. You know, there is this one saying in the marketplace, you know, even if you're right, markets, they can be irrational for longer than I can be solvent. So, you know, you never argue with the markets. Whatever they do, you hang in there. I mean, this thing has a price earning of 500, say 600. That means if I buy one share of this stuff, I need to wait 600 years for my stuff to double. How much is that for a return, really? I mean, again, this is a website. Could this be valuable to competition? Could something happen there? Could they mess up their business? Who knows? The risks are huge. But still, the marketplace thinks there is a massive growth about to happen. Well, you know, I was in the States when this thing was 100, and I clearly remember the days when in about 2, 3, 7, 5 months, it went to $5. So when you see it at 343, you know, I would think if markets get ugly, this thing could probably hit 25. Let's talk in 3 years, see if I was smart enough to know that. So, just last few slides, and then we go into options. There is troubled times ahead economically, just so you know. The solution of the problem of debt with more debt will not give better results. It's been tried many, many times, and one of the definitions of idiocy is trying to say the same thing over and over again and expecting different results. This will fuel massive, massive bubbles, and the bubbles I see at the moment is the bond bubble. When the interest rates are so low, you guys know there is a reverse correlation. Prices of bonds shoot in the sky. Many people are attracted to buying bonds at the moment because they've been growing for the last 10 years. If the interest rates go to normal levels, or even go to anything that's supposed to combat inflation, and 10, 15, 20%, the prices of bonds is going to crash so violently, guys. There will be a massive, I mean, this is a big, 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 big market out there. There is a sovereign debt bubble. Many governments have borrowed tons of money. They will never repay them back. They have no chance in the hell to ever repay them back. And most of these guys who bought this garbage will have to lose a lot of money. That's how it is. There is a massive risk of inflation. It's happening everywhere. We'll talk about it later if you'd like. By the way, ask me questions anytime if you'd like. You guys are not too many, so we can make this very informal. And there is, like we spoke earlier, the monetary thing. The dollar might well lose its reserve status. The more aggressive are they with the Russians, I mean, I'm not saying the Americans are very smart, but having a reserve currency of the world is a very beneficial thing. But sooner or later, somebody would say, I'd like to send my stuff for my own currency, or maybe for gold, maybe silver, or anything else that makes sense, not your garbage paper. So we go back to options now. Options are a fantastic derivative instrument. If you know how to use it, it has many applications, and it really makes little sense to actually buy and invest in stocks for speculative reasons if you know how to play with options. The options is, the markets for options is much more interesting, and if you know what you're doing and if you get it right, you can make your money massively. There is this guy called Thales of Miletus. Miletus is present-day Turkey, somewhere in Asia Minor. He was one of the great philosophers of his time, brilliant mathematician and so on. People would make fun of him. Well, if you're so smart, why aren't you rich? So he said, well, let me show you then. So he came up with all this idea. There was a normal market for olives. Every year, people would pick up their olives. They'll bring them to the olive mill and then make oil out of it. He, however, predicted much better than average, because he was a smart mathematician, I guess, much better than average, you know, yields and demand for olives. So he went to all these olive mills and say, hey, I'd like to give you a little bit of money now for the exclusive rights to lose your mill. People said, why would you do that? You know, you really don't. Come at any time. But he says, well, maybe I have an idea here. So what he did, the demand overwhelmed the prices. Prices shot up, and his little investment make him tons of money. Let me explain it in another way that makes much more sense. Aerosmith is coming to Sofia in about, what, on the 15th, I think. So, let's assume at the moment the ticket master sells tickets at 30 leva per ticket. And let's say, well, he goes back home, he says, I think there is something here. I want to make a little bit of money here. And he comes up with an evil plan. Not really an evil, it's a really decent plan. He goes to, before we know anything about the event, he goes, he does his homework and his computation. He thinks that the demand for this concert will be huge. So he goes to the ticket master and says, listen, I give you 5 leva. I'm not buying any tickets now, but I give you 5 leva for the option to buy these 1,000 tickets at any time from here to the beginning of the concert for 30 leva each. The tellers say, well, that's great. You know, they cost 30 leva. He's giving me 5. So if he buys them, I'll make 35 on them. That's great. So, okay, they keep you 1,000 tickets, and you pay me 5 leva for each up front. We take the money and we keep the tickets for you. Wonderful. So, we wait in suspense and see what happens. Now we have 2 scenarios in our prediction. Let's say in the first scenario, the Aerosmith show is again a hit. Steven Tyler is as popular as ever. So, the demand for the show is huge. Tickets sell out in a single day, and instantaneously there is a secondary black market for them. Let's not call it black, just call it a perfect efficient market. Only for market purposes, of course. And now the prices is up to 75 leva. People just queue up for this stuff. They want to see Steve Tyler. So, now he has a wonderful day. He has the option. They still keep 1,000 tickets for him. And he can buy them at 30 leva at any time. So he says, wonderful. He goes, he buys them at 30 leva. Assuming markets are efficient, he doesn't have to go in front of the arena. He just flips them around and he sells them for 75, right? So he made an investment of 5,000 leva, but his revenue, his profit was 35,000, which is the difference between 75, actually it should be 45, never mind. I didn't have my coffee this morning. So he made about 6 times his investment. It's beautiful for him. He made a little investment, only 5,000. He didn't have to actually pay up front, you know, for 1,000 tickets, the whole amount. He only paid a little bit. But then the leverage he got over this, as the prices moved his way, was great. So he made 6 times his money in this example. In the second scenario, nobody cares for poor old Steve Tyler any longer. And nobody shows at the concert. There is no demand for it. And the organizers really want to at least move some tickets, so from 30 leva they go down to 10. Well, he goes out and says, hey, I have tickets for 30, anybody? Of course, nobody wants them. They can go at the counter and buy them for 10. So, in this case, our friend loses everything. While his options expire worthless, nobody cares for his tickets. What this illustrates is, obviously, options are very, you know, you invest a little bit and you can make massive percentages if the position goes your way. But if the position gets around you, against you, you stand to lose everything. Therefore, you know, options are considered very risky instruments. They are indeed risky if you don't know what you do, and chances are you'll be wiped out of the market fairly quickly. So options is exactly this. It's an option. It's the right to either buy or sell something at a set price with a set period of time. The right to buy something is called a call option. The right to sell something is called a put option. I mean, have you guys read your chapters about this already? Okay, so there's 3 things you can do with an option. That's why it's an option. It's like a ticket to the concert. You can actually go to the concert, exercise your option. You just stay home and say, hey, I ain't going anywhere, so you just let your option expire worthless. Or of course you can turn around and sell it to somebody in the open market. And when I say I'd like efficient markets, there is a massive marketplace out there which is called the Chicago Board of Options Exchange, which is one of the biggest marketplaces in the world. People would normally, trade options there. So that's why it's an option. You can exercise your option if you wish, but you really don't have to do so. So real quickly here, they are derivatives. Options are called derivatives because their value is derived from the value of something else. And what it's derived from, it's called the underlying asset. In the example I gave you, the underlying asset was a ticket for a Aerosmith concert. And they trade on the Chicago Board of Options Exchange and the Chicago Board of Trade. There are few minor other exchanges, but they are really not interesting. The massive trade happens there. Some people would ask about what about futures? What's the difference? Pretty much they're all the same. Futures trade in another exchange, and they have, the principle is exactly the same. You invest a small amount and you bet a position, but the futures only trade for predefined amounts and predefined, say, mostly trade on commodities like wheat trades in bushels, the crude oil trades in barrels, gold trades in metric tons and ounces and so on. Right? Call option, you have the right to buy. You don't have to buy, but you have the right to buy. And the put option is the right to sell. You don't have to, but you want it if you do it. The way options appear on the market is somebody has to write them. The guy who writes to create the option is being created where somebody who has the underlying assets who wants to hedge his position and writes either a call or a put. There are three purposes of options: hedging, speculation, and arbitrage. Of course, the first two must be understood. They're very, that's what the game is all about. When somebody wants to get rid of his risk and wants to sell something right now on a predefined price over the next certain period of time, he eliminates the risk, he fixes the price, and he gets predictability for his business or for whatever his investment position is. Say you own 100 shares of Apple. If you think that maybe Apple is going to go down, but you still want to keep the shares, not sell them, because your grandmother gave them to you, you have such a massive capital gain on them, they are really unsellable. If you sell them, the government will take most of it. So you want to keep them, but you suspect they are overpriced at the moment, and they will go down. So you want to write a protective put, buy yourself a protective put to protect against downside risk. What will happen is if Apple really tanks tomorrow, you're going to lose a massive amount on your shares, but you're going to make the difference with a massive gain in the options. And you can do this with a little bit of an insurance. Obviously, if Apple goes up, you're going to lose that little bit of insurance, and you're going to cash in the difference with an appreciation of your stock. So that's something how it looks like. Here is Apple, that's 2012. Say you want to buy a protective put at 30. If it goes down to say 20, that's what happens. You protect it, and you still keep your shares. Now the other side of the equation are the guys who are the speculators. In everyday life, the word speculation and speculator has a negative meaning. There are very smart people out there who say that many problems of the world are caused by the so-called evil speculators. And was it not for them, we would live in a much better world where prices are always the best. Actually, the speculator is the one who takes the risk, and without him there is no marketplace whatsoever. If I have 2 cows now, let's assume we trade futures, and I think the prices of cows at the moment are $1,000 per cow or something rather, and we make a deal right now, so you actually eliminate my risk. The reason you take that position is because you secretly somehow believe, well, I think the prices of cows are going to go up, maybe 1,200, maybe 1,300, I don't know. So whoever is smarter from us wins. But these are massive markets, and these are these are important things. That's good. Normally when derivatives are listed, especially options, that's how they're listed in all those quotation sheets. Microsoft is the underlying asset, or in this case is Microsoft common stock. Then we have the expiration date. The month is July. Always stocks, at least options, traditionally expire on the third Friday of whatever month is shown. Lately, the last couple of years now, there's so many options, it's hard to find them. Now we have options expiring at the end of the market day today. There is options expiring every week. They're being created left and right. So the marketplace is even more efficient, you can say. This is the so-called strike price, and this is called the type of options. That's how you read the quotations. Again, the expiration date is the third Friday of the month, which is indicated. The strike prices used to be, that's obsolete. It used to be in increments of 50 cents, 25 cents. Now they trade just by decimals as well. A standard contract, this is important if you know, this is based on 100 shares. So one contract, you buy one contract of Microsoft options, it means you actually control 100 shares of Microsoft. As in anything, there are market makers, and the exchange is done with a bid price and an ask price for any option. If we go back here and we look what's going on with our Amazon at the moment, it's having it's down 1%. And if we click on the options here, we'll see the listings. So, say the April options, they expire on the third Friday of April. At the moment, the stock trades at $339. So if I think that the price is gonna tank, say with another $10 by the end of April, I need to go here and go to the put options, and my striking price would be, how much was it? 339, so we're looking something around there, let's say 335. But look how many there are. You need to, once you trade those, for example, 337, there's so many. So I would think that one is the first week of April, the second one, second week, and so on. But say the marketplace believes this stock is so volatile that if you'd like to make a bet that this thing is going to go down under 337 until the until the third Friday of next April, you have to pay, this is the bid price, and this is the ask price. The market maker who actually makes this market is actually acting like a change bureau in a way. He has a line of people, he has a buy price and sell price. Sometimes the spread between those is pretty high, like here. We're talking, this guy is flipping them by at easy 5-6% to one way or another. In other words, if you buy it with a market order, you buy it for 780. You need to get it moving your way and then eventually take his bid at 755. So because of that, when somebody trades options, and you find my slide maybe, there's several types of orders. Of course, if you make a market order, you immediately take his offer as high as possible as it is. If you're an active trader, that's not a good idea because you're an automatic 7%, 10% disadvantage. Normally, it's a better idea to put a limit order in between, somewhere between his asking a bid. Maybe you get a better price. You need to be patient, sit down and wait. Nobody gives money just like that. Or at least if you want to test his patience, the market maker, you give him a fill or kill type order, which means if he sells at 780, give it to me at 760, or this order is gone right away. Of course, another one is all or none, which is very important because otherwise you split the order into smaller pieces and charge you several commissions for this entertainment. What options are used for? The most popular thing, is income generation. Again, imagine your grandmother was very nice to you and left you 1,000 shares of Microsoft. You don't want to sell those shares, but you want to make money from them right now. So you say, okay, I think the market is flat or eventually drifting lower. So maybe I think if I write a cover call on my position, I'll make some money and I'll protect myself eventually against a possible fall in the Microsoft stock. So what you do is you see the market price and you give somebody the right to purchase your stock at that predefined price in the next whatever period of time. So again, wasn't I wrong last time I was here? This was Microsoft until April of 2013. That was last time I was here. So I suggested, okay, the price of Microsoft back then was $29. And I suggested to my lovely audience, let's make some revenue generation. After all, this is Microsoft. What a garbage company. Windows is going down. Who is buying Microsoft Office? Open source is everywhere. How could Microsoft do any good? So I said, okay, let's, at that time price was say 28 something. Let's write a covered call to sell Microsoft at 29 and get paid $1.50 for this entertainment. So had the market been flat, we would have just cashed in, take our 1,500 bucks, go to the Bahamas and really have some fun. Well, now this extended a little bit, so you could see that my recommendation occurred, say, right here. And as a very smart investor, I got it right. Obviously, the price from 29 went up all the way to 40. So let's rewind this today. Turns out that was not a great idea. Microsoft was up to 39. Your shares were called, that's for sure, because somebody, when they were here in January, they were, say, around this, he had the option to buy them at 29. The guy paid $1.50 for it. So with his stuff, he paid it for 29. So, and he turned around and sold them for 39. Actually, he didn't actually do this. He only sold the option itself on the stock market. So our mistake probably costed us 3 more trips to the Bahamas, I guess. But it just comes to tell you, you know, this time the speculator was right. So, you know. So that's his position. In any book on options, you see these are called options profit and loss diagrams. They're cute little charts. They show you, you know, what happens, how much money you make as the price. I mean, this is your profit, this is your loss, and this is how this relates to the option, to the share price. So if we bought this one put for $1.50, we're in the deep. I mean, we're in the red until it goes over 30.50. In our case, we went up to 39, so we cashed in quite some dollars. These charts are in any options book. I'm sure you've seen them. Just so you see them. Same idea goes with buying a put. When you buy a put, you speculate. See, back in the days, I was speculating that Amazon was going to go down. So I was preparing myself to put a January, 2014, now in the past. I wanted to buy a put. I was really expecting this thing to tank big, and I was going to pay $8.75. For 100 shares, that was 875 bucks. Well, if it didn't, like it did, I would have lost exactly that much. At least I would say, hey, maybe I try again. Now that it's at 400, maybe I try again. Maybe this time it does go down. That is the profit and loss for this same exercise. Once I pay my 875, I'm in the red. And this time I expect Microsoft to go down. So, I mean, if it goes down to 0, I stand to make, the entire difference. Sometimes it happens. Companies just go belly up. Probably the smartest thing as far as an option trading strategy is combination of these two. If these are the two basics, buy and a put, or write in a put and the other one, How about writing a combination of options? So there are two exercises that involve this. One is called a struggle, and the other one is called a strangle. And I've illustrated it with this slide. Say you expect some sort of a violent move in a certain stock. Normally violent moves happen. When I say violent, I mean sharp move up or down. When companies announce earnings or something as far as significant news, you know, sometimes prices tend to jump big. You know, this time it jumped from, you know, say 190. I mean, it jumped about $30-some, which is about 20% jump. It announces, normally it's good to see the volume chart here, you can see them, but once it announces earnings, you know, it's probably one of the best times to expect that this stock is gonna go somewhere. So let's imagine that, you know, this Friday, Amazon will have their conference call, and they're gonna say all this wonderful stuff about their company, but they'll actually announce their financial results. And what they really will tell us would be their earnings per share, the EPS. And we have to, based on this, we need to compute really what the valuation of this stock is. So this time, let's say we expect this move. We don't know which way it's gonna go. It could go up or could go down. So we just wanna say buy a put on this and buy a call at the same time, while hoping that it's gonna, just when it makes the move, it goes somewhere outside of these lines. And that's a very popular strategy, and that's how this chart looks. It's probably the most successful thing I've ever done is to strangle stocks. You know, you lose money if you stay in the range, but then if they really move sharply, you know, you stand to make good money. Sometimes the market does expect that, especially, you know, you're looking for cheaper options that expire shortly, and you just want to get the sharp move one way or another and cash in on this. But boy, even, you know, options on Amazon these days, even if they expire in 2 days or even 1 day, they're expensive as hell. The market knows how and expects this stuff. The idea to finding, you know, good investment opportunities is to look for undervalued stuff. Now, next one bit I have, pretty much these are the trading strategies in options. To understand the trading and how to eventually make $1 out of this stuff, you need to understand stock behavior. And stock behavior, I'm going to give you a little bit of clues about what technical analysis is. Technical analysis is just charts and cute stuff. Some people absolutely reject them. They believe, oh, I'm a fundamental stock whatever guy. I only believe in prices. But the beautiful thing about this is obviously it does reflect the behavior of a stock, but it also reflects the human behavior, the crash between the sellers and the buyers and all this equilibrium that takes place. The first thing to show is a candlestick type of charting. It looks like this, and it's actually a very cute little thing because it's much more informative. If you have a chart which says, okay, this stock just went down, pretty simple. It only takes the closing price of every single day. This is a bit more advanced. If this one is white versus this one being black, that says the opening price was here, this level. At some point, the price of this share went down to this price, and then had something like this, and finished like that. So that little bar is telling you a behavior like this. When the bar is black, it means it started here, it came to here, and it did something rather. So these are much more informative just by a general principle. When you look at this stuff, you can see the behavior. For example, you can see a classical, wonderful trading opportunity. Somewhere here, this thing was crashing for some days. It opened here, it started crashing, but then it stopped, picked up, and recovered all these losses and came back. Yeah, great. Here, this thing was shooting somewhere in the day. It went here, only to crash right back. Of course, to see the volume chart is always very good. Of course, that reflects human behavior. The more people trade, you know, normally, you know, there's tops and bottoms. They occur on heavy volume when this thing is happening. Very elementary stuff is the support and the resistance. What this is telling you is certain stock was trading somewhere. It came here. At this price, the sellers were more than the buyers, and they pushed them down. So the buyers came in, and so on. The third attempt, you know, obviously the buyers overrun the sellers, and then this thing shot. So the technical guys call this resistance, support level, when it tries to, and this is called a breakout normally. You know. That's a simple stock chart, which is very useful. 1 year chart is normally most preferable. It shows stock behavior best. First thing to look at is the moving averages, most accurate of which is the 50-day. Of course, the 200-day is also very important, although this stock is going very high, and its behavior is not its normal behavior. Once the stock price crosses over its moving average, it's considered for many a very bullish or bearish sign. There is a guy in the States called John Bollinger, and his analytical tool of his Bollinger Bands is excellent. You can see it in most advanced charting tools these days. Normally it's telling you this is not exactly the most accurate Bollinger Bands that I can show you, but normally it says, if you ignore this sharp movement, that a price of this, I mean, it's computed, I don't know exactly how, first derivative of average, mean, or whatever. But it tends to stay within it. It tends to hit it, and they'll hit it back. And sometimes these are very, very accurate when you do. It's just a hint I'm throwing you. If you really want to do a more advanced research, just a clue I'm giving you here. The most reliable indicator that I know is the relative strength index. It's pretty accurate, especially when a stock move goes to extremes. It normally moves between 20 and 80. Anything over 70 is considered very overbought. Anything under 25 is also considered overbought. When something gets sold and sold and sold and sold at some point, it kind of indicates how much, you know, the sellers have pushed the buyers or the other way around. So sometimes it's getting to an extreme. It's really very rare in the marketplace to see somebody just push somebody and just take him out. Normally it's like two people pushing each other, but you know, it always comes back and so on. So history shows, at least in my book, that this perhaps is the most accurate one if you want to speculate on options. If it gets like this, chances are this thing's going to reverse at some point. Unless, of course, the market always finds a way to, you know, penalize you. The Fibonacci retracements, what are they? Remember?
More or less.
More or less. Well, very simple stuff. The Fibonacci retracements pretty much say that if something, you know, starts from, what you want to do is, you know, the Fibonacci chain is every number is equals to the sum of the previous two ones, and the relationships between them are most important ones at 25, 38, 50, and 61. What this actually means when you do technical analysis, and especially if you want to speculate in options or something, say you have this stock and it's made a dramatic move. At some point you say, well, maybe this is about to start correcting, maybe at least something. I just think it's too much of a buying activity. So what you would normally do is you take the starting point of the rally, go up to wherever it peaked, and you can certainly could make an argument. Look at the volume here. Maybe that was the crescendo of this business. So if I expect a 25% correction, I would automatically compute. I take the difference from 11 to 40 is 28 bucks. So if I just go for 25% correction, I'm seeking somewhere around $30. If I go to 50, I mean, if you're right, you don't want to just short here and eventually cover right away. You really want to milk this baby until it actually happens, you know. That's a very interesting one. I made it on purpose, and it shows about some ideas you're gonna see about the investment behavior, which is my experience tells me is pretty true. And let's suppose you just graduate out of the American University in Bulgaria. You think you're the hottest shot out there, you know it all, and it's just about time that you go and make a killing on the market, right? So you take your $1,000 and you go and you buy the first shares of XYZ. What is going to happen, chances are that's how it's going to play out. Say you just buy them, and in about a week you look in your account and you see this thing going up to 25. Now you say, I told you, I knew I was exceptionally smart, and it turns out this thing was pretty easy. Investment is easy. Took me just a week and I made 25% on my money. Boy, if this thing keeps going, I could probably become a millionaire, quit my stupid day job, and make a fortune in about 2-3 years, and maybe retire. This is just great. In another week, you look back in your account and you see this thing is down. You say, huh, that was kind of unexpected. But of course, I've seen this, you know, just as it was, you know, 25. Let me wait another week. It's certainly gonna be back there. And of course, next week you wake up, this is a 22.50. You say, of course, see, I was right again. Now, in no time, this will be right back, you know, where it was. Now, this thing in third week comes here. Now, that's new. This time you see the color red in your book. And you say, ha, so far it was, you know, only profits and, you know, eventually break even. Now I'm kind of losing money. That's kind of not good. You know, I'm quickly losing my grandmother's money here. What do I do? Okay, well, of course, I'm not going to capitulate now. I'm just going to hold on. It's going to come back, of course. And next week, what you see, of course, it's right back. And you say, that's great. See, I was right. Good thing I didn't panic and I didn't sell. So from here, I know I'm going to see black again. I mean, red again. So what happens here this time, you get really panicked. Now this is something you haven't seen. Now your account is half its value. You're starting to really panic. You realize, hey, you know, I lost 50%. However, it takes 100%, a whole double for me to even come back with my money. But, you know, I'm just going to hang in there and I wait. So next day you come up, you see, aha, halfway in. Too much pain for me, sucks, but the moment I wait, I'm sick of this garbage stock. I'm just going to dump it. What really is going to happen is next morning when you wake up, you would really panic and you're going to say, well, wasn't I completely wrong? And then you're going to capitulate right here. This is your absolutely typical human behavior. And is, of course, the absolute irrational human behavior. But it happens over and over and over. And most people just can't help but do it on the stock exchange. And to just elaborate a little bit better, let's assume we have a simplified stock market here. Let's assume we have 3 players. The good, bad, ugly, whatever I call them. So let's say one of them is a very sharp cat. He knows, he does his homework, very hard working guy. The other one is an average investor. And the third one is the massive majority of people, which are the dumb investors. All right? So let's say we have a stock and it sells at $5. And Mr. Smart Cat, nobody's talking about this stock. It's just some stock somewhere. Somebody says, well, you know, I think maybe there is something here. He sits down. He does an extensive homework. He researches this and he says, well, you know what? I think $5, that thing is cheap. I think maybe, I mean, at least 10, maybe 20, it becomes expensive. So he moves in and quietly buys. He's just by himself. He doesn't know much. So his buying demand pushes up the price of this thing. Now this thing kind of becomes a market mover. It gets noticed on the radars of other investors. So comes the average investor who says, huh, Let me take a look into this. All right, it was 5, now it's 10, maybe good. Okay, I'm in. It sounds like a very hot thing. So he buys at 10, or whatever we got. Yeah, whatever. That buying pressure puts further demand, so the prices goes up to 15. Now this thing is news everywhere. It's on the front page of yahoo.com finance. And then comes Mr. Joe Blow and says, I told you that's the next best thing. I am coming in. You can't go wrong. Look at this chart. This thing is going great. So he comes in. Problem is, this guy, when he made his judgment, he said, well, maybe at 15, this is too expensive. So he says, why don't I sell at 15? That was my plan anyway, right? So the moment the least intelligent people are in the market, pretty much the demand is over. There is no more demand to push the stock price even further. So at this point, this demand collapses. I mean, not collapses, but it peaks. The selling pressure from this guy puts it down. He didn't sell here. He said, I'm going to hang in there. He sold again here and made nothing. This guy kept. And this thing, when he sold, there was further crash. And he surrendered and sold right here. And guess who he sold it to, you know? The guy who thought, well, this thing is back at 5. Maybe I come back in, you know? So that's how it works. It's your classic investment psychology story. Another very good market indicator you want to check in if you trade sometimes, it's called the VIX, or the Standard & Poor's Volatility Index. It's just the ratio of calls and puts in bullish positions versus bearish positions. History indicates when this thing gets low, people are way too optimistic about markets. And when people are way too optimistic about markets, that means most people are already in, and chances of serious new demand to come in to push these things up are less and less. When things get bad or markets panic, I mean, people just go to the other extremes as well. And let me finish with some common trading wisdom. I got a few bits for you. Maybe you find some wisdom there. Trading is one of the most difficult things I've ever seen in my life. I really find it, every day I find it extremely hard. And I pretty much don't do it any longer. But to be anyway somehow successful at this stuff, you must work really, really hard at this. You must be an absolute independent thinker. It's like don't even want to talk to people. Just want to sit down at home and do your own homework. You need to have a massive understanding of economics, money, and psychology. Most of this stuff you're not going to learn at AUBG. Chances are slim for that. You must understand philosophy and history, and try to focus on anti-human behavior. Don't act like that guy or the other guy in the example, but try to focus. I mean, you have to act like, you know, in a different way. You know, for every dollar you make, somebody else would lose it, and your trading opponents would be some of the smartest cats on the planet. Everybody being out there trying to make a dollar, especially for newbies who want to taste, you know, the quick buck. You need to actually always look for values in companies, especially when you do your analysis. The earnings per share are very critical, together with all kinds of other things. But these companies overstate them, they lie about them, you need to take them, you discount them, and so on and so forth. A good company doesn't mean a good stock. Somebody could say, well, boy, Facebook is great, blah, blah, but the shares of Facebook are tanking meanwhile. Maybe they're expensive, that's why. Companies lie and say all kinds of cute stuff about themselves which make very little sense. That was CMGI. That was when I was in Boston. That was one of the biggest dot-com bursts in history. I mean, of Boston. So stuff they say is throughout their subsidiaries, they provide supply chain management services, and in fact, they were just providing hosting for websites and some other, you know, venture capital for websites. Then they went bankrupt massively. You need to ignore the crowd and be an independent thinker. Be extremely disciplined. Never mind the television gurus. They're they're not very intelligent people. And sometimes some of the things they say are just outright, just maybe somebody's agenda or maybe just not true. Here is a beautiful example. That's Japan. This is Fukushima right here. When everybody freaked out and thought that maybe Japan was going to disappear tomorrow and never will be any Japan whatsoever, and they panicked and they sold. I mean, what a wonderful buying opportunity Fukushima was. If anybody understood anything about government and so on, they would have realized that, okay, maybe the Mr. Abe, his name is Mr. I am the guy who's going to ruin Japan completely. He was going to introduce another massive government spending stimulus, whatever program, and the spending in especially constructor sector and rebuilding sector. But that was just a stunning opportunity. Just the other day, when I noticed those big headlines, the Russian stock market is being crushed finally, and the Russians are going back to the boots. My wife sent me to Telex. I bought some rubles. Where are the currencies here? If I could only show you. Anyway, what I was going to show you is when the headline started, 1 ruble went up to 50 something, and now it crashed down in just the last months when everybody thought just Russia was about to disappear out of the face of the earth. So it's euro, ruble. Yes, no, maybe. Anyway, back to my lecture. I'm having technological problems. Oh, I actually had it. There you go. That's what I meant. Exactly what I was going to show you. This is very, very recent. You know, it comes to show you just when every time everybody starts, you know, running away from something, it's just the time and place. This is very important to remember what your mama told you. Buy low and sell high. Always. Don't buy high and don't sell low. If something is too good to be true, it is. And you want to learn about money and exponential growth. So my second slide is identical to this one. This is very, very important. This one is extremely important. I'll throw you some hints. Maybe I did already. You need to learn about money and exponential growth. And you want to learn what wealth is. And one good thing that you want to learn if you want to become rich is what is inflation, what inflation is. That cute little picture shows you what one currency unit of Bulgaria as of today, which is worth nothing. It used to buy stacks and stacks and stacks. Bulgaria itself had about 6 currency reforms in the previous century alone. I would think this century would see at least that many, maybe. And many money will come and will go and will disappear. But the idea of what exactly money is, what should be money, and how to use it, and you know, it's something you want to think about, because all your life you want to go and work for somebody, create a business. At least work for money, not for some garbage substance somewhere. The exponential growth is a very important idea. You want to understand it. That's the story of the Persian king who met with the guy who invented chess. He was looking for ways to reward him. You know the story, everybody does. But it does come to show you that once something starts doubling and going into a geometric, you know, into exponential growth, the exponential growth is extremely hard to sustain. For example, you have 1, 2, 4, 8, always once something doubles, it's always a bigger number than the sum of all the other ones taken together. Once markets start going bubblish and they go overextend themselves, or even simple assumptions like what happens if tomorrow we double the entire world oil production and keep it like this for the next 10 years. That would at some point mean that maybe we have to produce more oil in a certain small period of time than we've ever produced in our history. So some things, for example, commodities business, we're seeing a growth and a growth and a growth and a growth, which is going to peak at some point and it's going to crash. Same goes with currency production and so on. Once the currency life gets out of control and it goes really exponential, history shows it's impossible to stop and you got to run for the hills. This is our little friend right here. And this is $1 trillion in $100 bills. That's a trillion with a T. This year alone, we're going to see many of those created throughout the world. And it's something to really think about. And that's all I got for you. I'll take questions if you like, but you've been wonderful. Yes?
So in your presentation you were mentioning about the trading more with options rather than stocks, and you were seeing it better.
Yes.
Like, in terms of risk, how they are better, let's say,
They're much worse and the risk is higher. Okay. You can easily lose everything if the position goes in against you. Also, if you're disciplined, you really have to cut your losses, because if you lose a position, you can't recover. Especially if you play a risky play. Say you have a stock here and it's just going like this, and all of a sudden you buy a short-term put, say put, expecting this thing is going to go down in the next 2 weeks. Maybe you get it right, but what if this thing just goes like that? In the beginning you need to be disciplined and eventually kill this position right away, or protect yourself on the top by buying a call at the same time. So the winnings of one compensate for the winnings of the other one. But of course, if you try to do this, if these are short, remember, they have time value and it expires every day. Obviously, if you expect the price of Microsoft to go under 40 for the next 10 years, there are very good chances of this happening. Therefore, the price of the option will be very expensive. But if we're talking about the next 2 hours or the next 2 days, we don't know. So it becomes very risky. Chances are, unless you're an exceptionally good trader, if you play with very short options, you'll be applying for the community service of Blagoevgrad for looking for a job. You go bankrupt. Unless you know what you're doing, of course. I never did.
Yeah, but my question is why this lecture is more about options than not more about stocks? Basically, maybe you had some more interest in options and...
What could I tell you about stocks? You buy a stock, you hold it, or you short a stock, which means you borrow it from somebody and you expect the price to go down and then buy it cheaper. Pretty much that's it for stocks. And okay, obviously stocks are ownerships and blah blah, But stocks, if we talk about stocks, we look at them, how they compute, how the price earnings compute, what the trading mechanics are, and so on. I have a lecture in these stocks as well. But this is more exciting stuff, because with little money, you can just, if you do it right, At $400 a share, if you buy a minimum lot, not a minimum, of course, but your normal lot of 100 shares, that's $40,000. I know you're a wealthy guy, but not everybody is. That makes it hard. Just one share being $400. You buy 10, you pay commissions, it's hard. Versus you buy, okay, you give $150 and see what happens. Yeah. Yes, dear.
What do you think are the reasons behind the overpriced prices of Amazon and Microsoft? Because you said you were expecting them to fall. And you think they're overpriced.
Listen, if I come to Burgas airport and I import a massive ship full of the highest quality whiskey in the world, right? Imagine, say, Johnny Walker Black Label, something. And I bring it here, I mean massive quantities, and I dump it on the market, and I say, this costs nothing. This costs 2 leva, 5 leva for the bottle of the finest ones. Maybe at some point the population will start having a drunken problem, don't you think? What I'm saying is, when you have the distortion on the marketplace comes by, you know, prices shouldn't be fixed in a free market. When the main interest rate is fixed at a ridiculously low level, cost of money is 0 right now. You take money from the central bank, or you don't even have an incentive to save. You want to dump them somewhere. If you're a major investment bank, and you can, I mean, a monkey can do this. You take money at 0%, and you give it to the government at 4%. And you take it again, and you do it. A monkey can do this, right? So just because, so if the savings rate is nothing, 0.5%, you have money and you wonder what the hell to do with it. And people are not very creative. Very people start the next best thing. People say, gee, you know, let me buy a new apartment, you know, or let me buy some land. They don't make any more of it. You can't go wrong with land. So that fuels a bubble in the US everywhere. Look at how expensive prices of real estate are. Just because all this capital needs to go somewhere. Same goes with these ridiculously high stock prices. Because there's so much artificial credit out there, it's just trying to find its place. At some point, it dries up and the crashes are violent. History shows at least that. But you don't know. If inflation goes on like this, geez, this market could go up to 10,000, 20,000, 100,000, who knows? Markets can stay irrational for longer than I can stay solvent, you know. That's, if you get this, it's a very important point. Most of the professors of finance, am I over the time? Okay. They believe that's, you know, the predominant school of thought in economics. I'm sure you've read that. Talks about the business cycle, right? Which is something like this. The presumption is, okay, you have an economy, and it goes. At some point, it crashes, and then miraculously, the very smart bunch of government guys jump in and start dumping credit on the market, and people start producing more, and we have the gold days again. This is about to discredit itself hugely in the coming years and in decades, because once you get into the exponential growth right here, it becomes completely out of control. It's happened many, many times, and it's nothing new really. But they give Nobel prizes for that stuff. Really? Yeah, great question. Any other great questions today? What about you? What do you think?
Everything is all right.
Everything is all right. Okay. Well, there you go. Everything is all right.
Can I ask you an off-topic question?
Sure.
Why did you decide to transfer to Maine?
That was 2000. That was 1997. There was no stable electricity in Bulgaria. As any self-respecting country, you can, that has a government change, some sort, the regime change you call it. Bulgaria had socialist communist, you know.
Yeah.
So that changed, and there had to be a process of ownership being from government hands had to go to private hands. So that was a long, violent process. Took a while. There was a massive inflation robbery in Bulgaria as well, where the amounts of lev in circulation were just became, the lev lost its value in about no time. So everybody was robbed of their savings. The entire generation was completely wiped out, the wealth of entire generations. Had you saved, been prudent to save and invest in whatever currency it was, you would have lost everything. Everything crashed and the country had to start over again in a known recipe with an international money fund and so on and so forth. Living in Bulgaria back then was very hard. There was no underground, there was nothing. There was just any light whatsoever. Belgorod was nothing like you would think. Where are you from?
Kyrgyzstan.
Kyrgyzstan.
We have the same background. So
if Kyrgyzstan is smart enough, the politicians of Kyrgyzstan, which I really doubt, they could make it a very, very nice place and could be a marvelous little country to live in. I wouldn't count on the smartness of your government, though. You know. Sad that the Crimeans just had they had a referendum, these guys, but only had two questions. Do we stay with Ukraine? Do we go to Russia? There should have been a third question, you know. How about we make a little nice independent country, free and prosperous, like some guys know how to do. But that wasn't on the ballot, so. You don't expect too many smart things from them as well, you know.
There was actually a problem with it because there's a null agreement between Ottoman Empire and Russia that if Crimea becomes independent, actually Turkey has the right to claim it as its own land. So
I didn't know about that. But I'm sure if they make their little, it's a very small place. Keep their bases and all, but if they could easily make a lovely Switzerland, wealthy and so on. But they'd rather somebody, you know, yeah, well, we can talk about federal governments in a whole new lecture, if you like.
But still they have still kind of Soviet psychology, and I doubt that they would make it like Switzerland. For example, if you consider self-declared independent countries like Abkhazia, and they're also small, they're also on Black Sea shore, but we see that they don't achieve anything yet, and bombs.
thank you again.
Yeah, my pleasure. Thank you for coming.
This program is brought to you by AUBGTalks. For more, please visit us at aubg.edu/talks.